The primary effect states that what comes first is where we place additional significance towards. So we focus on the things that come first. So if we put that into the context of the accountancy formula, sales minus expenses equals profit. Generally accepted is how we produce our statutory accounts. No one's expecting anyone to change the way they do the statutory accounts, by the way. But from a behavioural aspect, when we're operating our own business, if we're focusing on sales minus expenses equaling profit, then the emphasis we put on our business is to increase sales constantly. Sell, sell, sell. The money that we produce through our revenue then gets consumed by the expenses because we kid ourselves that this is the money that we need to be able to bring those sales into our business. This then creates us being stuck in that month-to-month cycle of the money coming in, the money going out. Now we need to sell again and we need to get the money in the business quickly so that we can pay all the expenses that we believe we need to run the business successfully. So going back to the primary effect, let's flip the formula. So the profit first methodology states profit first. Therefore, we flip the formula to say sales minus profit equals expenses. Now we've got a different trajectory with our focuses and our energy. So of course we still attribute sales as our main focus because we need to bring money into the business. There has to be revenue for us to be able to take our profit. But now we take our profit and what's left, we then run the business on. So our primary focus is the sales and then the profit. How does this help? So as an accountant or a bookkeeper, I'm sure you've produced a set of year-end accounts for a client. The client comes in, maybe into the office, maybe it's on a Zoom call, maybe it's on a telephone. You congratulate them. Well done, you made a profit this year. The client says, great news, but I don't understand. Where's the money? Of course you laugh. The money's already gone. You've spent it. But you can't really give a understandable answer because the profit is an accounting profit. What does that mean to the business owner? And then, of course, you mentioned that they've got a tax bill due to be spent. And so now the client's got their head in their hands and they're thinking, wow, and I've got a tax bill and it's 6 months after my year end, so I've got 3 months to find this money that I don't have saved up. Wouldn't you like to be more proactive with your clients? Wouldn't you like to be able to say to your client, okay, I've got a strategy here. I can say to you that in 18 months, 24 months time, you're going to have this amount of money. You're going to have already paid yourself this amount. You're going to have this amount of profit and you're going to have the cash to show for it. You're going to have this amount as a tax bill. And yes, it is quite a lot of money, but that's okay because that money is going to be in your tax pot. We've saved that through allocations from your revenue coming into your business. So as long as you can keep that revenue coming in, we can look after the cash in your business. And what it means is there's less money for you to spend. So those impulse buys, those monthly subscriptions, the money that's just going out of your bank month after month because it always has done, even though you don't need it to, it's all going to stop. This proactive way of working with your clients will mean they will love you forever. They will have clarity on their money and they will have a forward-thinking accountant or bookkeeper that they know has got their back. That's why profit first flips the formula and the emphasis is on the profit.